What if I told you that most investors lose money not because they buy the wrong stocks, but because they never learn when to sell? Today I'm going to reveal the exact framework that separates profitable investors from those who watch their gains evaporate. Stick around, because by the end of this video, you'll have a systematic approach to locking in profits that could transform your entire investing strategy. Quick disclaimer, I'm not a financial advisor. This video is for educational purposes only, so always do your own research before investing. Here's the brutal truth that nobody wants to admit. You can pick the perfect stock, time your entry flawlessly, and still lose money if you don't have an exit strategy. I've seen investors turn winning positions into devastating losses simply because they didn't know when to walk away. The difference between amateur and professional investors isn't stock picking ability, it's discipline around profit taking. Let me share 3 core principles that will revolutionize how you think about selling stocks. First, always sell when your investment thesis breaks down. This sounds obvious, but most people ignore it completely. You bought Tesla because you believed in their electric vehicle dominance. Then 5 new competitors enter the market with better technology and lower prices. Your original reason for buying no longer exists, yet you hold on hoping for a miracle. I call this the Thesis Check Method. Every quarter, ask yourself this simple question: knowing what I know today, would I buy this stock right now at the current price? If the answer is no, you should seriously consider selling. The market doesn't care about your purchase price or your emotional attachment to a position. Second principle, use systematic profit targets before emotions kick in. Here's what successful traders do that retail investors don't. They decide their exit price the moment they enter a position. If you buy a stock at $50, you might set a profit target at $75 and a stop loss at $40. This removes emotion from the equation entirely. But here's the advanced strategy most people miss. Use scaling exits instead of all or nothing sells. When your stock hits your first profit target, sell 25%. Hit the second target, sell another 25%. This way you lock in gains while still participating in potential upside. It's the perfect balance between greed and fear. The third principle is portfolio rebalancing, and this is where most people make their biggest mistake. Success can actually hurt you if you're not careful. Imagine you bought Nvidia 3 years ago and it's now 60% of your entire portfolio. You're sitting on massive gains, but you're also exposed to catastrophic risk if that one stock crashes. Professional money managers have strict rules about position sizing. No single stock should ever represent more than 10% of your total portfolio, regardless of how much you love the company. When a position grows beyond that threshold, you trim it down. This isn't pessimism, it's risk management. Now let's talk about the psychology that destroys most investors. There are 2 emotions that control every decision in the stock market: fear and greed. Fear makes you sell winners too early, you're up 30%, and suddenly you panic that you'll lose it all. Greed makes you hold losers too long, always hoping for that magical comeback that never comes. The solution is creating what I call emotional circuit breakers. These are predetermined rules that override your feelings in the moment. Write down your exit strategy before you buy. If the company's revenue growth falls below 20% for 2 consecutive quarters, I sell. If my position grows to more than 15% of my portfolio, I trim it. Having these rules in writing removes the emotional decision-making that destroys returns. Here's a real-world example of how this works. You buy Amazon at $200 with a plan to sell half your position if it reaches $300. The stock hits your target and you sell half, banking a 50% gain on that portion. Then Amazon continues climbing to $400. You're still participating in the upside with your remaining shares, but you've already locked in substantial profits. But what about stop losses? This is where things get controversial. Some investors swear by them, others think they're wealth destroyers. Here's my take. Stop losses work best for traders and nervous investors who can't handle volatility. If you're investing for the long term in quality companies, temporary price drops shouldn't scare you. However, if you're retired and can't afford major losses, or if you're investing money you might need in the next few years, stop losses can provide valuable protection. The key is setting them at technically meaningful levels, not arbitrary percentages. The biggest mistake I see investors make is treating unrealized gains like monopoly money. That paper profit in your account represents real purchasing power. Every day you don't take some profit is a day you're choosing to reinvest that money at current prices. Ask yourself, is that the best use of your capital right now? Remember, nobody ever went broke taking profits. Your job as an investor isn't to maximize every single gain, it's to compound wealth over time while managing risk. Sometimes that means leaving money on the table, and that's perfectly fine. The most successful investors I know treat selling like a business decision, not an emotional one. They have systems, they follow rules, and they never let their ego override their strategy. Develop your own systematic approach to profit taking and watch your long-term returns improve dramatically.